Hi everyone. Today we are going to see lesson 1 of capital market and securities. In this chapter, that is lesson 1 is your basics of capital market. In this chapter, we are going to see what are the basic terminologies that are used in the capital market and what is your money market, what is your capital market, what is your secondary market, and all of those things we are going to see in depth in this chapter. So, this is an important chapter as this covers the basic structure of a capital market. So, let's see. So, when we see uh, the regulatory framework of basics of capital market, we have Securities and Exchange Board of India, that is your SEBI 1992 Act. So, SEBI Act will act when the securities are listed on the stock exchange. When the company is listed on the stock exchange, then the SEBI Act would prevail. Then the SEBI Act would apply for the company as well as the securities. And your RBI Act, as you know, because there's a transaction of money for the securities, the RBI Act will apply. So SEBI Act will apply whenever there's a capital market, and the RBI Act would apply whenever there's a money market, because money market involves short term funding requires for the company. The money market, the company would choose money market to for their cash requirements. Then you have foreign portfolio investors, alternate investment funds. These all we will see in depth in the later part of the chapter. So let's see the financial system in India. So what do you mean by financial system? Financial system is a place where the securities are being traded. So people, we have, as you and me, we have funds. We will invest our funds into the capital market or the money market, and in return we will get the best returns out of it. So that is where we invest our money and we will get our returns. That is your system. There's a people invest their money to the company which requires funds, and the company will improve its financial stability and improve its all of its it will be stable, it will grow, and we also grow together with the company. That is a cycle. So people, as we invest our money, and the company will give returns to us. So financial system, it helps in protection, capital, economic growth. So it will grow. It will enhance our saving habits. This is important. This will enhance our saving habits, and it will mobilize our savers. Mobilize means that they will collect money from us, and they will grow. And together we also grow together with them. And there is always a cash and credit transaction, and various factors. That is the capital market, because various factors like RBI interest rates, global any events that can influence the capital market and its growth as well. So the strength of the economy is calibrate different economic indicators like GDP. In economics, we have seen like GDP, GNP, and all those factors which can interest rates, inflation. Okay, so GDP. Okay, this can influence our returns based on the events that has been happening over the global as well as in India. Okay, so let us see the components of financial system. So what are the basic components? So we have three components: the financial market participants, and financial instruments. So financial market is segregated into two types, which has been classified into two types, which is your money market and is your capital market. So money market is where the short term liquid funds are being traded. That is, the maturity of the money market instruments is less than a year. So in money market, we have instruments like commercial papers, certificate of deposits, treasury bills, and bills of exchange. These are the major instruments that are being traded on the money market. Whereas in capital market, we have securities market and other form of lending and borrowings. Securities market is where the new issue markets and the secondary market. It has been further classified into new issue market and secondary market. New issue market is where your IPO, initial public offering, where the company at the initial stage they will issue the shares to the public. That is your initial public offering. Secondary market is where the shares which are already being issued are being traded among the investors. So we are buying shares of a company from an existing investor. That is called a secondary market. The place where we buy is called a secondary market. Another form of lending and borrowing is where your debentures, bonds, etc. will prevail. And your financial market participants, as you all know, the as we individuals we may participate, and the qualified institutional buyers. Qualified institutional buyers means they are the big players. They are the institutional buyers, not the retail buyers. They are the institutional buyers. So they have to be qualified as an institution. Not every institutional buyers is a qualified institutional buyers. They have to be qualified based on the criteria laid down by SEBI. They have to qualify. And foreign portfolio investor is where the investor of a foreign territory invest in the company of it. India as a foreign portfolio investor. There is also a specific criteria for foreign portfolio investors. And alternative investors, venture capital, all these things we will see in deeply in later part of the chapter. So let's say that anchor investors, HNI, merchant banker, RTA, underwriters, banker to issue, demonstration, all of the things you will see in the later part of the chapter. And financial instruments like shares, debentures, bonds, IDR, warrants, shares, debentures, bonds, IDR, warrants, REITs, invites, ETFs. ETFs is a kind of instrument which is a index. So which tracks the performance of an index is called as ETFs. So this is the basic structure of the basic components of a financial system. And we see the financial markets. This is just an introduction. So as the financial market has been existing over 200 years old. It is the oldest. It is one of the oldest stock exchange, fastest growing and among the best among the financial markets. And it is a more than 200 years old. This is and the BSE, the Bombay Stock Exchange, is the first stock exchange that has been founded in 1875, almost 8 decades after BSE became the first stock exchange to be recognized by Indian government. Indian government has recognized the BSE as a recognized stock exchange, and the NSE has came later on. That is in 1992. The NSE has came. The NSE is a new stock exchange with new features, as and the functions of financial market. Functions is where the financial market. What all you can imagine that the financial market, the functions. Financial market is where we invest our money and we get returns. The company will mobilize and the company will grow, and we also grow together with them. And we can determine the price of the securities using the financial market. So based on demand and supply of the securities, we can identify easily the price of the securities and provides liquidity. Liquidity means we can change the securities into cash in the immediate basis, which can be converted into cash easily. And readily we can sell our securities and our assets into cash. And reduces cost. Okay, it facilitates the exchange of assets without there is no physical delivery here. We can easily buy and sell securities in the stock market and the stock exchange itself. So if we buy shares of the Reliance, means we are buying shares, not any physical delivery is happening. So it is all on the electronic. It is all on demat account. And the financial market we saw earlier. The financial market is divided into two categories. That is your money market, and another one is your capital market. So we can choose the in functions like mobilization, channelization. Okay, determines the price of the securities. It provides liquidity, and it reduces cost, and it exchange of physical. It facilitates exchange of assets without physical delivery. Okay, so let's see the two main classifications. That is your money market and your capital market. So money market, as I stated earlier, money market is where the short-term funds, the maturity of these funds is less than a year. Is from 1 day, ranges from 1 day to 1 year. That is less than a year. That is a short-term funds. The company borrows funds from the investors, and the investors, the maturity of this is no less than a year, and is regulated by both RBI as well as the SEBI, because the RBI is where the monetary transaction is being taken place. So the RBI is a regulator, and the securities, is a listed money market instruments are listed on a stock exchange. So the SEBI, the securities are regulated by the SEBI. Such a way that is, so in this money market, not we small investors, we cannot afford to buy instruments on the money market, because the application size, the high volume in nature, it is high in volume in nature. That is minimum, you have to invest 1 lakh or 10 lakhs like that for 5 lakhs. So it is high in volume. So it is mostly dominated by the small number of large players. Large players means because the person who are having more amount of money, it is dominated by the small number of large players. Okay, so it has a negotiable instruments, that is bill of exchange, certificate of deposits, commercial papers, or visa, and it has a liquidity, so which can be converted into cash easy, which can be easily converted because it is a quoted in stock exchange. So we can easily see the price, and we can easily convert them into cash by selling the instruments to another investors, and with minimum transaction costs and no loss in value because we already know the price of this instruments, treasury bills, commercial papers. So treasury bills, commercial papers, these are all based on the less than a year. So this will have a maturity, that is 91 days, 182 days, 364 days. Based on the maturity, it expires. On the expiry, they have to give the principal. The company has to give the principal amount to the investor, and it facilitates the conduct of monetary policy of an economy, because it determines the it facilitates actually the monetary policy. So whenever there is a monetary policy, it facilitates the monetary policy of an economy. So that is all about your money market. And your capital market, that is obviously your stock market. So is where a financial system that is concerned with the investor securities market, government securities, long-term loan. This is concerned with the long-term loan market. Money market is concerned with short-term, that is less than a year, and medium and long-term. So medium, so from the ranging from medium to long-term liquidity needs of borrowers and lenders are taking place. And the main thing is it acts as a barometer of the economy, because if I want to see the health of any country, I will see the uh, health of the stability of the stock exchange. If the stock exchange is more stable, the prices are going up, the index, the Nifty 50, the Sensex, all these index are going up. It is in a stable manner, means we can state that the country is in more stable condition. But whereas if the market is crashing means you can easily state that, oh, okay, so this country is more vulnerable to invest. So this country is more of not healthy in nature. Okay, so in this capital market we have shares, stocks, debentures, bonds. Okay, this is basically your stock market. So capital market raise funds. So why do the company uh, make this? Why do the company list in capital market? Means to raise funds. Company needs funds, and investor has funds. Investor will give funds, and the company will grow, and the company will give returns, and the company as well as the investor will grow together. Okay. All infrastructure facilities for the companies and the corporate activities, that is day-to-day working capital requirements, these all can be raised from the capital market. Okay. So why do we as an investor and as the company needs this capital market? One important thing is money requirement. The company needs money. So it is important we should channelize mobilize funds. Mobilize funds means it transfers money from the investors. So investors invest and the company will get. So it transfers money from the investors to the company, both private and government. Government companies can also get listed on the stock exchange. One second. Yeah. And it provides an effective source of investment. So if people are having money, if they are having their money and doing nothing, it will reduce in value over a period of time because of inflation. So it acts as an effective source of investment. So investors can invest their money in the stock market. Okay, it mobilizes savings, same points as we saw in the functions of financial market. In addition to resource allocation, it provides a medium risk for management by allowing the diversification of risk. So in this capital market, we have diversification of risk because uh, we have various number of securities. If the investor is having 10,000, he can invest in some in shares, some in debentures, some in bonds. So their risk is diversified because of this capital market uh, instruments. And technological progress, the improvement of technological progress. Okay, and employees via ESOPs. So, in the capital market, if the share price is, let's say, the share price of Reliance is, let's say around 3,000 means, so the employees of the Reliance may get it at a discount rate based on certain conditions. If they follow certain conditions, they can get it at a predetermined price. That is called as ESOP, Employee Stock Option Scheme. We say that is in a predetermined price. They can exercise this option, or they cannot, or they won't exercise this option because of the reduced in price. This and all we see in the later part of that subject. Okay, current cycle. So through share swaps. So disinvestment also. If you are investing, if you are there's an investment, there is also a disinvestment. I can, if I have the option to invest, I can also have the option to disinvest. That is, sell off my shares and liquidate my shares and get cash. The functions of capital market is same as the functions of financial market. It acts as a mobilized resources, and buying and selling of securities happens. Efficient price discovery. So with the help of the capital market, we can discover the price of the securities based on demand and supply, based on various factors, global events, interest rates. Okay, so we can determine the price of the securities and facilitates settlement of transaction, which can be easily settled through clearing corporation. There is a clearing corporation which settles the transaction easily without any delay, without any without any reduced transaction cost. They will settle the transaction in the capital market. And the securities market is also a place where can price funds by issuing securities. So this is also the same as capital market. There is no such difference. It is the same as they will issue equity shares, debt securities, that is derivatives, mutual funds, okay, etc. to the investors. And it is also a place where investors can buy or sell. So this is most common where we can buy and sell the securities which we have bought. And market financial instrument claims are commonly readily available for transfer by means of sale. We can sell all the shares. Okay, the functions of secondary market. This is also the same. We say that takeaways is a link between investment and savings. So we have our savings. They are investing our savings into the capital market so that the money grows. The money itself grows based on the company. If the company grows, our money also grows. So, and mobilizers, channelizes savings, liquidity, purchase and sale of securities. This is the same thing. Na? So you can write the same functions of capital market, financial market, securities market in all the answers. That is the beauty of this three markets. So you can write all there's the same points only. And securities market has broadly categorized into two, which is your primary market and your secondary market. This is important concept. Primary market, uh, primary market and secondary market. Primary market is a market where the company issues fresh instruments, fresh securities to the company, to the investors through IPO. So if an investor want to purchase the shares in the initial stage, they can apply for the IPO and they can get their shares, such as equity, preference, debt instruments. All of the things are issued by the company. And as an investor, if you want to buy the shares from the company itself, we can buy directly from the company by applying through IPO. And the prices are between bidding range. So for let's say for example 500 to 600. So how many people are bidding? How many number of people are bidding on the specific price? That price would be coded as a price of the securities. That is the pricing mechanism of the IPO, initial public offering, and activities of stock exchange. So yeah, it is also known as initial public offering. That is IPO market. IPO market. There are major two types of issuers who are there. One is your corporate entity. That is your company. That is your private company. Yeah, corporate entities, they will issue shares, debentures, bonds, etc. And another major player is your government. One is your corporate entities and another one is your government. Government also issues these type of shares, debentures, all those things. And these are QIPs, qualified institutional buyers, can also raise funds through the IPO. and IDR, GDR, American Depository Receipts, ADR, GDR, ECB. This is all we will see in deeply in later part of the chapter. Okay, secondary market. Secondary market is where the securities are issued and the investors has already bought. If let's say that I want to buy shares of Reliance, let's say I want to buy shares of Reliance, I cannot go directly to Reliance. I can open a demat account in any broking apps and I can directly purchase from the another investor who is willing to sell those shares. So I am buying the shares of the Reliance through another investor. That is your secondary market. So I cannot go directly buy shares from Reliance because it is already being listed and all the shares are being quoted in the stock exchange. So it's a market for trading and settlement of securities that have already been issued, which can be bought and sold in the secondary market through registered brokers. You can open a demat account through any registered brokers like Zero, Grow, Angel One. So you can open a demat account through them and you can buy shares in the stock exchange. Okay, so this is a important table that displays your difference between the primary market as well as the secondary market. Meaning, there is the primary market is issuing of fresh securities. Whenever the company is initially issuing the shares or securities, the place where they will issue the securities is the place where the securities are being issued is called as primary market, and the secondary market is where the trading are already being issued. Shares which are already being issued is called as secondary market. Objective to raise funds. So initially the company issuing securities to raise funds from the investors. And secondary market is where the capital appreciation. Your capital gets appreciated based on demand and supply. And includes is IPO and further trading. It includes further trading, that is investor to investor. We can further trade in the stock exchange. Another name IPO and after issue market. Okay. So for their expansion, if the company wants to expand, they will get listed on the stock exchange and then they will issue securities to the company. This is not any funding. This is just a platform for the funds get appreciated. You can get best returns from them, but the company cannot get funds from through the secondary market. And the parties are the directly between the company and investor. The investor can directly go to the company, apply for IPO, and get their shares. And the secondary market is where the investors among themselves. There is no company involved here. And major intermediaries like underwriters and your brokers. Underwriters is where whenever the company is issuing shares, okay, the minimum subscription according to your ICDR chapter, you will see in the later part. ICDR chapter is minimum 90% of the value should be subscribed. If there is an undersubscription, the company cannot raise funds from the investors or the company cannot list on the stock exchange. So to reduce the error in minimum subscription, that is your minimum 90% subscriptions, the company will appoint underwriters who will take care that if the investor is not applying for the shares, the underwriters will take care of it and they will subscribe to the shares. That and all we will see in the later part. Let's say that the major intermediaries in the primary market is your underwriters and the secondary market is your brokers. That is your Zero, the like brokers, RTA, register and share transfer agent. All those brokers, we have intermediaries. We have a separate chapter, intermediaries. We will see in deeply. And the prices in the offer document, we have offered a red herring prospectus. We have a price range, that is 500, 600, 1000, 2000, 100. We have a price range, that is the price. And this is fluctuates based on your demand and supply forces. It fluctuates. Okay. And utilization becomes the primary market, becomes the capital of the company. It becomes a capital because we are directly buying shares from the company, so that it becomes the capital of the company. And this becomes the income of the investors. As we invest in the secondary market, this will become our income in the stock exchange. And regulatory framework for securities market, we have 4 regulators. That is, your main regulator is your SEBI, and next one is your SCRA Act, Securities Contract Regulation Act, and one is your Depositories Act, and the main thing is your Companies Act. You will see all those things in the later part of the chapter. Later part, there is a separate chapter. It's SEBI, SCRA, depositories, all of things. We have a separate chapter. You will see in deeply in there. Okay, the SEBI, the main thing, the main object of the SEBI was to protect the interest of the investors. It's to protect the interest of investors. They have to protect the investors, because as we investors, we invest our money in the stock exchange. So the SEBI has to protect the investors, and the main object is to promote and development of securities and regulate the securities market. Have a number of irregularities in the securities market, so SEBI act as a regulating agent to regulate the securities market. And SCRR Act, we will see in deeply in the later part. Okay, and need for regulators. Why those 4 regulators are required in the capital market is where we have the investors felt deceived and were losing trust in the securities. So there were many scams, there were many malpractices, like non-adherence to rules. The company may sometimes non-adherence to rules that will act as a default or deceived or losing trust in the securities. So there is a famous scam, that is your Harshad Mehta scam in 1992. It involved scam of 4,000 crores of market manipulations were happened. So there's a huge scam. It gradually crashed in 1992, and when the SEBI came in the 1992 as a regulatory agent, and this is the major need for the major need for regulators in the capital market to increase the trust among the investors to invest their securities in the capital market. This is the major need for regulators in the capital market. And SEBI, when did the SEBI came on the year 1992. So before that, we have a controller of capital market. Controller of capital market, the regulator is called as a controller. Which was the controller of capital was repealed on the year 1992 with the invent of SEBI. SEBI replaced the controller of capital market. Okay, so the SEBI's major object is, as we saw earlier, the major object is to protect the interest of investors and promote the development of securities market and regulate the securities market. So the SEBI will regulate whom? SEBI will regulate the issuers, that is your companies, as your governments or your corporates, who issues the securities to the people and the investors. And the investors like you and me, they will protect us, and the financial intermediaries like brokers, underwriters. So all those things, the SEBI will act as a guiding agent, and they will regulate, and SEBI will regulate all these 3 players. So participants of capital market. Who are all the participants in the capital market? First one is your qualified institutional buyers. From the name itself, they are the institutional buyers. They are not the retail buyers. And they have to be qualified. To become a institutional buyers. Okay. So they are the institutions. They will not buy in a volume of like thousands or lakhs. They will buy very huge amount. They will buy in a huge, large scale. They will buy. That is why they are institutional buyers, who generally possess expertise in the financial market, and they will invest in the securities which gets them best returns. Okay, mostly how come the qualified institution buyers get funds? The HNIs, the high net worth individuals. High net worth individuals will give funds, to the qualified institutional buyers, and this qualified institutional buyers buy shares or securities in the stock exchange. Securities in the stock exchange. They have to be, so as I stated earlier, they have to be qualified. So what are the qualifications? What are the criteria required for the institutional buyers to get qualified? So to get qualified, as in to qualify as an institution buyer, there is a certain regulations that is formulated by SEBI. If you follow this is criteria, or if you're not under this criteria, you will qualify as a institutional buyers, qualified institution buyers. This is your main regulation 21 SS of SEBI, issue of capital disclosure regulation 2018. That is your ICDR regulation 2018. To become a qualified institution buyers, you should not fall under this any of the qualified institution buyers comprise of these things. So all these things are categorized as qualified institutional buyers. The mutual fund, venture capital fund, foreign portfolio investor, public financial institutions, commercial banks, multilateral and bilateral development financial institutions, state industrial development corporations, insurance company, provident fund, pension fund, and national investment fund, insurance, systematically important non-banking financial NBFCs, systematically important NBFCs. So these are all covered in qualified institutional buyers. Okay. So this is the main criteria. You can take somewhere around 6 to 7 points from this, and you can build your answers according to the paragraph here. Okay. So the foreign portfolio investors. Next main topic. The qualified institutional buyers can itself be asked as a separate question in the exam. So this is an important topic. And the foreign portfolio investor is another important topic. This can also be asked as a separate question in the exam. So this is the important topic. So the means person is a person who is registered under chapter 2 of SEBI Foreign Portfolio Investor Regulation 2019. So here the person has to be registered in the chapter 2 of SEBI Foreign Portfolio Investor to become a foreign portfolio investor. There is a two concepts, which is foreign portfolio investor and foreign direct investment, FPI and FDI. If a person who invests in a listed company less than 10%, he is being qualified as a foreign portfolio investor. If the investment crosses the 10%, then it is treated as foreign direct investment, and all the foreign direct investment rules, FDI policy, that is your consolidated policy, would act in the FDI norms. So till now, we can consider a foreign portfolio investor. There is mainly two categories, category 1 and your category 2. What is category 1? So let's see first the category 2. Category 2 is where anyone who does not fall under category 1 is category 2. This is very simple, right? So any person who is not falling under the category 1 becomes automatically under category 2. So now let's see what they have stated in category 1. In category 1, mostly there are all big players like your governments, like your FATF members. Okay, so the government and government related investors, your pension funds, your appropriately regulated entities such as insurance. Appropriately regulated entities means an entity which is already being regulated under different act. So insurance means IRDA Act, Insurance Regulatory Development Authority of India is regulating the insurance sectors. So which is already regulated by another entity is called as appropriately regulated entities. And your banks, which is under RBI, asset management companies, investment managers, investment advisors, portfolio managers, these are all securities market intermediaries. You will see deeply in the intermediary sector itself. And entities which are member of FATF, that is Financial Action Task Force member countries, are also covered under the FPI And here also they have mentioned the appropriately regulated funds and unregulated. Even the entity is unregulated, but the investment manager is appropriately regulated. Then also it is covered. Even the entity is not covered, but the investment manager is covered. Investment manager is appropriately regulated, so that the entity also get covered in the category 1. Category 1. And any university which has been in existence for more than 5 years are also covered in category 1. And another part is an entity whose investment manager is from FATF member. So here the investment manager is an FATF member, and such investment manager is category 1 portfolio investor. He is also registered as a category 1 portfolio investor. Is covered in category 1 of FPA, or which is at least 75% owned, or there is a holding subsidiary company. If a company is holding another company of at least 75, so holding subsidiary company means at least 50%. Okay, here at least 75% is owned by another entity, and such owning entity is categorized in category 1. Then the other entity also categorized in category 1. So simple. First one is the entity which is from the FATF member. So let's see, that is your government, pension, and appropriately regulated, that is your insurance, and any investment manager. And the university's investment manager is appropriately regulated, but no entity is not regulated. Then it will categorized under category 1. And any entity which is owning another entity of at least 75% or more, and the owning entity is categorized under category 1, automatically the other entity also categorized by category 1. That is what they are trying to tell in the 5th point. Yeah, 70% directly or indirectly by another entity. And category 2 is very simple, because which is not falling under category 1 falls under category 2. All the investors not eligible under category 1, such as your here also appropriately regulated, but not eligible as category 1. They are appropriately regulated by another regulator, but they are not eligible in the category 1. Not eligible in category 1. Any endowments, any charitables, any corporate bodies, any family officers, individuals, here where the individuals comes, and any unregulated funds. Okay. This is very simple. So there is 2 categories. What is meant by FPI? Any person who is investing in a listed company of less than 10% is categorized under category 1. Is called as FPI. And there is 2 categories: category 1, category 2. Category 1 talks about your big players like government, insurance, pension, appropriately regulated, investment manager criterias, holding subsidy like 75% criterias. All of those things you can write. FATF member countries. Category 2 is your endowments, individuals, family officers, any appropriately regulated entity, funds which are not eligible as category 1. All these things are covered in category 2 of FPI. And another major concept is your alternative investment funds. Alternative investment funds is a private pooling of funds. Alternative investment funds is defined in regulation 21B of SEBI, Alternative Investment Funds Regulation 2012. It is a private pooling of funds. This is the major word here. It's a private pooling of funds. Okay. So this alternative investment funds is a structure which can be formed in any LLP, company, trust, body corporate. In any form, it can be structured as a alternative investment funds. And it's a private pooling of funds. And how do these funds get funds means, they will approach HNI, high net worth individuals. They will approach HNI, and the HNI will invest in higher alternative investment funds, and this AIFs will invest in other companies, which is like a startups or like any other companies, which gives them best returns. And it's a private pooling of funds, and it's not covered in SEBI mutual fund regulation, SEBI collective investment schemes, or any other regulations. If the entity is not falling under any other regulations, but they are privately pooling funds from any persons, means they are covered in alternative investment funds. And however, there is a negative list. These entities also collect funds, but they are not covered under the alternative investment funds. Family trust, ESOP, employee welfare, holding companies, special purpose vehicle, okay, including securitization trust, and funds management securitization company. Securitization company you will see in the later part also, but I will give you a basic meaning of securitization company. Securitization company is a company which borrows assets which are already mortgaged. So let's say that I had mortgage in my house and I bought like 10 lakhs loan from the house, 10 lakhs loan from the house, which is already mortgaged. So banks will get periodical interest from the mortgage amount. So what this bank do now? This bank will sell this mortgaged house to the mortgaged assets to the securitization company for a discounted price, and the securitization company will take care of all the interest payments, take care of all the collection, principal interest collection. All those things will take care of by the securitization company. So this is the basic thing about the securitization company. We will see in the later part of the chapter. And any others which is under RAF will not cover up. This is all negative list. If the structure falls under any of those categories, any of the 7 categories, they will not be classified as the alternative investment funds. This is shall not be considered. Okay, and there is a category. So as we saw in the FPI, there is 2 categories. In AAF, there is 3 categories. These AAFs will invest based on which category they are falling. If they are falling under category 1, they will invest based on that. If they are falling in category 2, category 3, based on that, they will invest based on the category in which they are falling. So basically, there is 3 categories. One is your category 1, 2, and 3. So category 1 is where it includes VCF, that is venture capital fund, SME funds, infrastructure funds, all covered in category 1. So what they will do now, they will collect funds from the HNI and they will invest in the startup companies. Startup companies do seed funding, that is initial stage. They will invest in the startup companies and any company which have a social impact, which have a social invest in startups, or which have a social ventures or SME or infrastructure, because in the startups it is a high risk. Whenever there is a high risk, there is a high return. So based on the probability, they will invest on the startup companies and the companies and the corporates which have a social ventures, and called as it includes BCFs. Okay, and category 2 is where it is not falling under the category 1 and category 3, which is not falling under category 1 and category 3 falls under category 2, which is private equity funds. Private equity funds we will see in the later part, and debt funds. Okay, so category 3, what is your category 3? That is your hedge funds. Hedge funds is where complex trading strategies. So they will invest in the complex trading strategies like derivatives. Derivatives is where we will buy. There is a concept of call option, put option, futures, options, all these things. So mostly derivatives, they will ask the some part. Some part will be taken in the different video, because mostly derivatives are asked in the sum. Okay, so let's say that category 3 AFs will invest on the hedge funds. Next one, that is your complex trading strategies. Derivatives are considered as high risk in the capital market itself. It is considered as high risk so that it will give high returns. Unlisted, listed or unlisted derivatives. So we will see the category 1. We see the venture capital. Venture capital is where they will invest on the startups. They will invest as startups. Okay. Investment may be venture capital fund, potential of high rate of return because startups is a high risk and it has a potential of high rate of return. Startups and emerging early stage social ventures, intellectual property, biotechnology, nanotechnology, all those things they will invest in the um, startup companies to get a high return, which may give high return or high loss. High return or high loss. Areas of investment. Where do these venture capital fund invest? Based on the category, based on different venture capital groups have different investments. Based on, so some may prefer biotechnology, some may prefer communication, some may prefer medical services, some may prefer whatever, you know, based on the category in which they are falling, they will invest. Okay. So that is the area of investment. And another important concept is your private equity. Private equity. So private equity is where they will invest on the equity shares. They will invest on the equity shares of a private company. They will invest on the equity shares of a private company. This is a type of equity. This is a type of equity which takes securities and debt. They will say take securities as well as they will invest in debt that are not publicly traded because they are investing on the private companies. Investing on the private companies. So here also we seek help from the HNIs. HNIs are classified whenever the HNI is having above 2 crores of investable surplus. So HNI is whereas a person who is having investable surplus of 2 crores or more is categorized in HNI. So HNIs would invest in private equity and the private equity will invest in the private companies. The revenue sources, okay, make investment directly into the private companies. Okay. And yeah, that is all about your private equity. So types of private equity. Types of private equity is where they will invest on the leveraged buyout. Leveraged buyout is where you're investing by taking a loan from, like let's say bank, you're taking loan for a interest rate of 11% or 10%. You are investing in another company to get a possible returns of 15 or 20%. The difference between the interest rate and your returns is your profit. This is considered as a high level of risk that is involved in investing in this type of strategy. And the venture capital is where you're investing on the startup companies to expand the business. Growth capital is where you invest on the expansion basis. And another part is your angel fund. Angel fund is considered as the angel for the startup companies because as an angel, these angel fund investors will invest in the angel fund and this angel fund will invest on the startup companies on the initial stage itself. The seed funding will done by the angel fund on the initial stage. The first two created by HNIs. So HNIs will invest their funds into the angel fund and for this investment and this angel fund will invest on the startup business. Okay, this is company generally known as angel investors. And angel investor is also known as a business angel. In the corporate segment, they are known as the business angel. And they provide capital for the business startups on the initial stage itself. They do seed funding. In return, what they will expect from the corporate company is that they will either expect their ownership of equity or they will expect convertible debt or ownership of equity in the corporate entity. So rather than monetary investment, they will also give guidance to the young entrepreneurs. They will also help entrepreneurs to shape their business models because the entrepreneurs will have good amount of capital, but they do not have the idea to how to expand their business in the corporate sector. So they will also give the angel fund entrepreneurs. They will also give the business ideas on how to develop these products based on the patents that you're having, based on the product viability that you're having. They will help these entrepreneurs to get their business to develop in the corporate sectors. So, yeah, entrepreneurs, often angels or entrepreneurs who have successfully, they had already built their business successfully. So, based on the experience, they will give a career in coaching young companies, career in coaching young companies to develop in the corporate sectors. And another important concept is your anchor investors. Anchor investors is where these investors act as an anchor, act as a major anchor to the company, because these anchor investors as to the minimum application value for investing in any company is 10 crores. Is 10 crores. That's such a huge amount. 10 crores in the main board. Main board is where your NSE BSE. Subordinate board is your SME stock exchange, innovative growth platform, social stock exchange. These are all classified as subordinate boards. Main board, on the main board, if the anchor investor want to invest, means they have to invest at least 10 crores, and in the subordinate board they have to invest at least 2 crores. 2 crores. And this is made in accordance with the chapter 9 of ICDR regulation, made in accordance with chapter 9 of ICDR regulation. And up to 60% of the portion qualifying shall be available for allocation to anchor investors. So that is, if a company is allocating 60, if allocating, let's say 10 crores to the qualified institutional buyers, so up to 60%, that is 6 crores, can be allocated to the anchor investors. And allocation to, what are the allocation criteria? This is important because this involves monetary criteria. This can be asked in exam. Wherever there is a number, this can be asked in the exam. Okay. So this has been classified in for 2 categories. That is, one is your main board and another one is your SME exchange. So if the anchor investor is investing and the allocation is up to 10 crores, means maximum of 2 such anchor investors are allowed. Maximum of 2 such investors are allowed. If the investment is above 10 crores but is up to 250 crores, then minimum to maximum 15. Subject to minimum, one investor has to invest at least 5 crores. And in case the investment amount is above 250 crores, let's say that it is 300 crores, then minimum of 5 investors is allowed and maximum 15 investors is allowed for such 250 crores. And above 250 crores, that is, let's say if you are investing 300 crores, means above, that is 300 minus 250, that is 50 crores. Additional 10 such investors are allowed, but at least 5 crores has to be invested by per investor. Per investor shall contribute 5 crores. This is for main board. And SME exchange, the same criteria, but the numbers will differ. Maximum 2, here it is 2 crores. It is not 10 crores, it is 2 crores because of SME exchange. Here, if it is above 2 crores and up to 225, means minimum 2 and maximum 50. If it is above 25 crores, then minimum 5 and maximum 15, and additional 10 allowed for every. But such one investor shall contribute at least 1 crores, right? 1 crores. This is all about your anchor investors. And another thing is, anchor investors are investing huge amount of money. So the bidding for the anchor investors shall open 1 day before the issue opening to the another general public. So 1 day before it will open for the anchor investors, and the allotment of shares will happen on the day itself. On such day itself, the allotment of shares will happen, and the shares or the securities shall be locked in for a period of 30 days from the date of such allotment. Shall be locked in for a period of 30 days. Shall be locked in for a period of 30 days from the date of such allotment. Okay, the same criteria as we stated earlier, up to 60% of portion available to QIB can be available for the anchor investors. So 10 crores on that 60% to the anchor investors. On that anchor investor, that is 6%, 6 crores. 1/3 1/3 of the portion shall be allocated to the domestic mutual funds. That is 2 crores shall be allocated to the domestic mutual funds. Okay. And next up is your high net worth individuals. So high net worth individuals, there is no one single definition. There is no definition to determine who's high net worth individuals. But generally, if we see that whenever a person who is having over 2 crores of investable surplus, whenever a person who is having 2 crores of investable surplus may be considered as HNI, and whenever a person who's having a range of 25 lakhs to 2 crores may be deemed as an emerging as an HNI. There is no specific definition, so there is no legality here. You can say that generally, if any person who is having 2 crores of investable surplus, he is considered as an HNI. He is considered as an HNI. And pension fund is generally is established by an employer. Generally, in government companies, they will give pensions to the persons, right? So those amount of pensions can also be invested in the stock market to gain returns. Can also be invested in the stock market by the pension fund authorities. It is generally created by an employer, and the employer shall contribute such percentage of amount. Employee also shall contribute such percentage of amount on the date of retirement or on the date of requirement by the employee. It shall be given to the employee from the pension funds, commonly run by UTI, AMC, NPS, National Pension Scheme. Employees like National Pension Scheme. Okay, so we can access through these schemes, and even private companies can also give pension fund to their employees. And legislation, this pension fund is covered in this Mines Pension Fund, EPFs, gratuity. All these legislations are covered in this pension funds. Okay, there is broadly 2 categories. One is your formal, and another one is your informal pensions. Formal can be in the act by way of government, by the way of voluntary pensions. It is considered as formal. Informal is where the pensions is given to unorganized persons, like unorganized workers. If you are giving pensions, means that is in the informal sectors. This is also we will cover in the later part of the chapter. Okay. So next, let's see the capital market instruments. This is not that important. I don't think that this will be asked in the exam, but this is, we need to know. According to the equity shares, what is meant by equity shares? The definition is given in the section 43 of the Companies Act 2013. About the equity shares, about the equity capital. Equity shares can be with the voting rights or differential rights as to different voting. So it can be classified in 2 categories. One is with the same voting rights, and another one is your different voting rights as to dividend or voting. Different rights as to dividend or voting. Okay, so equity shares, we have voting rights, general meetings. Okay, this is not that important, and enjoy different rights as members. Right to vote, we can, as an equity investors, we can right to vote. We can right to receive copy of annual accounts. Right to appoint a proxy to attend the general meetings. Okay, right to inspect the registers, right to inspect the major documents of the company. Okay, and listen to facilitate the exercise of the following rights. These rights are also additional rights are also available to the equity shareholders. Right to participate, opportunity of being heard. Okay, so and shares with differential voting rights. This topic is important. This can be asked in your exam. This topic is important because shares with different voting rights. Different voting rights can be given as to their dividends, either as to the dividends or as to the votees. Like if I have a shares, if I have a differential DVR, if I have one DVR means I can get a 2 or 3 voting rights based on the proportion of shares that a company is willing to give to the shareholders. Or if it is with the dividend, I will get dividend as to the proportion mentioned by the company. Okay, the Tata Motors, issued by Tata Motors. They are the first to issue their DVR in the stock exchange. And one main thing is the following conditions. While issuing DVR, you have to follow these conditions. These conditions are important. This can be asked in an exam. So if you follow these conditions, you may voluntarily issue DVRs in your company. First one is your articles of association. Your articles should allow you to issue DVRs. And voting power shall not exceed 74%. 74% any DVR or the total DVR, the voting rate shall not exceed 74%, because for special resolution we require 75%. So for the purpose of this, they have given this as a limit to 74%. So no DVR shall exceed 74%, and your shareholders approval by passing ordinary resolution is required, and there is no default in filing your annual returns, repayment, redemption, all this, repayment of term loans, statutory dues, all these things are, you have to follow these criteria to issue the DVRs. And preference shares. Preference shares is, you have a preference when you have a preference as to the dividend. You have a preference as to the dividend amount and your repayment of capital. In case of when the company is winding up, you will be treated as, you will get a preference over the equity shares. In the waterfalls by the IBC code, you will get a preference over the equity shares. Equity shareholders are considered the last stage of the IBC waterfall. Preference shareholders is one step above the equity shareholders. So you will get a certain preference by holding the preference shares and to the dividend. There is various kinds of preference shares: cumulative, non-cumulative, convertible, non-convertible. Okay, this is all not that important. This can be covered in the later part. That in the company law, you have this convertible, non-convertible, these kinds of preference shares. Okay, debentures is an instrument which evidences a debt, which is an instrument which evidences a debt, evidencing a debt over on that instrument. Okay, debentures section 2 subsection 30 of the Companies Act 2013. Debentures include debenture stock. Debenture stock means what? Debenture stock is a one debenture which has a huge amount of volume. It's called as debenture stock, bonds. It evidences a debt. That is the main part here. Evidences a debt. The important features is certificate of indebtedness, pay interest, and on the maturity it has to pay the principal. They do not have voting rights, because equity shareholders they get their voting rights, but in debentures they do not get any voting rights. Okay, so categories of debentures, there is 4 categories. Fully convertible debentures, that is FCD. These debentures can be convertible fully into the equity shares. It can be converted into equity shares without any premium. Okay, this can be converted into equity shares. Non-convertible means this cannot be converted according to section 56 of the Companies Act. This cannot be issued. But for the purpose of understanding, you can say that non-convertible debentures which cannot be converted into equity shares. Okay, and partly convertible debentures. Partly convertible means which can be the debentures can be partly converted into equity shares and which cannot be partly convertible. So both the aspects are there. 2 kinds of, namely convertible, non-convertible. Converted into equity shares at the expiry. Non-convertible portion cannot be convertible. It can be redeemed at the expiry only. Okay, optionally fully convertible. You have the option to convert into the equity shares. Option is a kind of debenture which can be converted into equity shares at the expiry of a predetermined price. At a predetermined price, you can convert this debentures into your equity shares. Equity shares, it is hybrid in nature, because you can convert or you cannot convert. You may not want to convert. This is hybrid in nature. Okay, bonds is also similar to the, it also evidences that it has a maturity. It is a considered in a long-term perspective with 5 to 10 years. If duration will be 5 to 10 years. Okay, similar features like debentures. It has a fixed face value, fixed maturity date, repay the principal. On the maturity date, they have to repay the principal amount also, and you can diversify. And types of bonds, the corporate companies can issue bonds, the governments can issue bonds, corporates can issue bonds, and banks, and there are tax saving bonds also there. Next, another important concept is your foreign currency convertible bonds. From the name itself, it is a bond. It is a bond which can be convertible, convertible into equity shares, and it is denominated in the foreign currency. It is denominated in the foreign currency. It is a bond that is issued by an Indian company. So, it is a bond issued by Indian company expressed in foreign currency. Indian company which expressed in foreign currency, and the principal and interest. Whenever there is a bond, remember, whenever there is a whenever there is a whenever there is a bond, uh, exit. Uh, whenever whenever there is a bond, there is a concept of principal plus interest. Principal plus interest. At the date of maturity, the principal has to be repaid to the investor, and the interest has to be repaid periodically based on the category of the bond. Okay, so let's say that it is a bond issued by an Indian company, but that is expressed in foreign currency. That is expressed in foreign currency, and the principal interest is repayable on the foreign currency itself. Okay, and it is payable on dollars. That is your foreign currency. It also carry a fixed rate of interest. There is no such difference. So only thing is it is a bond which can be convertible and is expressed in foreign currency, which is issued by an Indian company. Just issued by an Indian company. Same similar point is here also in the foreign currency exchangeable bonds. This is also bond. Bond means what? Principal plus interest, and which is denominated in foreign currency, which cannot be convertible, which cannot be convertible, which is exchangeable. Exit. Which is exchangeable, with the group companies, which is exchangeable with the group companies, Okay, which is exchangeable with the group companies. Group companies means what? The company which is issuing the bonds, the investor cannot convert their bonds into equity shares with such company. They can exchange with only the group companies. That is, if the Tata Motors is issuing the bonds, means they cannot convert the shares into Tata Motors. They can exchange their bonds into equity shares of the group companies like Tata Group. Another group companies they can convert. That is an expressed in foreign currency, principal interest, issued by Indian company, same as earlier, resident outside India. But here the main thing is exchangeable in the equity shares of another company. Exchangeable in the equity shares of another company means what? That is your group company. It is also called as offered company. Which is an Indian company, either wholly or partly on base of equity related warrants. Okay, which is their group of offer, promoter group of offer. They can convert this bonds. You can convert these bonds. And another concept is your Indian depository receipts. Indian depository receipts, according to your section 2, subsection 48 of Companies Act, means any instrument which is in the form of depository receipt created by domestic depository. Means what? Domestic depository is your brokers, the Zerodha, Angel One Grow. It is created by domestic depository, not your overseas depository. In the foreign currency exchangeable bonds and your foreign currency convertible bonds, there is an overseas depository. It is expressed over because the shares are being bought in the overseas. So here, but the idea is Indian depository, which is created by the domestic depository, an authorized by company outside India, but it is created by the domestic depository. It is denominated in Indian rupee. It is denominated in Indian rupee. Okay, and the first company to issue IDR is your Standard Chartered. Standard Standard Chartered, and only company which issue IDR in your Indian market as well. Okay. Then your derivatives is where you will see the derivatives will be asked in the exam, only the major some part only, but I'll give you the basic thing about the derivatives. Derivatives, which consists of futures, options, swap, call options, put options, margins. All these terminologies are related to the derivatives, futures, options, It if in options, if there is a segregation call option, put option, it gives a right. So the call option gives a right to buy the shares, but not the obligation to buy. We have the right, but not the obligation to buy. So that and all we will see in the later part. Let's now understand the derivatives is an it can be it has a different types. It has a different types. It has been defined in the Securities Contract Regulation Act. It is a security. It is a security that derives its value. It is a security that derives its value from the underlying asset. We which have underlying asset. We have Reliance. Reliance is a share. It has a value of, let's say, around 2,000 to 3,000 means it derives its value from the underlying asset. So derives the value from the 2,000 or 3,000. Okay. So a contract derives its value from the price or index or underlying securities, commodity derivatives, such are the derivatives as may be declared by the central government. And warrant is also an option. Warrant is also a right to buy, but not the obligation to exercise the option. So a warrant is issued by the company mostly to its promoters, mostly to its employees, to retain them in the company. So to retain means I will give a warrant. I will give a warrant as a company. I will give a warrant to my promoter with a predetermined price. That the share price, if my company's share price is, let's say, 100 rupees, I will give at a predetermined price. That is, let's say, at a discount rate in 70. I will give and it will be exercised on there is a maturity period. After the maturity, either the promoter can exercise the option or it can be lapsed. If it is favorable for this promoter means he will exercise the option, or else he will generally lapse the option, but not the obligation. It has a right, and we have the right to hold a warrant, but it is not the obligation to exercise them into equity shares. If it is favorable, we can. If it is favorable, we can exercise, or else we can lapse it. This example is clears your doubt. There's the price of the conversion is 70 and the current market price is 110. So to convert the option, the price that I'm getting at the discounted price 70, but the current market price is 110. I will enjoy the capital gain of 40 rupees, because on converting this option, converting this warrant, I will get a profit of 40 rupees. But in the other way also it can happen based on the market demand and supply and fluctuations. So if the current market price is 40, I will generally lapse the warrant. And another concept is your REITs, that is real estate investment trust. REITs, it is generally formed in the structure of trust, and they will invest on the real estate activities. As you and me, the investor, we cannot go and buy directly on the real estate properties because it is huge in value. So rather, what these trusts will do, they will collect funds from the investors, and with such investments they will buy the real estate property, and and this real estate trust has to give periodical dividends to the uh, investors, up to I think 90 percentage or something should be given to the real estate investors, but owns, operates, or finances income. Okay, allows anyone to invest in portfolios. Any persons can invest. It is also called as mutual fund. So you have a mutual fund, REITs, or it is a concept of ETFs, which tracks the performance of the real estate activities. Okay, REIT can earn. Okay, less can. What are the benefits? What are the benefits of the REITs for investors? It is this capital. We can invest very little minimum amount, very capital intensive. Okay, compared to more affordable, not a large capital. We not provide large capital. Small investors, it is suitable. It is transparency because it is all the details are publicly available. So it is more transparent, and assured dividends. Periodic dividends has to be given to the uh, real estate investors, and it is tax free, capital appreciate. Okay, easy to buy because on the demat account itself we can buy. Okay, infrastructure, the same concept. It is also a trust, but here they will invest in infrastructure facilities like roads, bridges, all those things which generates income, like toll gates, which generate income side. So on the incomes, it will be distributed to the infrastructure investment trust investors. So a suitable platform, the same concept as REITs, but here they will invest in infrastructure facilities by encouraging more individuals to invest. Okay, it is formed in the basic formation establishment of trust is we have four major parties. One is a trustee. One is a trustee who are required to be registered SEBI, and who is appointed, who creates this trust, and he also has to invest at least 80% in infra assets that generate steady revenue, because you have to give income to your investors, right? So this trustee has to invest at least 80% of those assets in the infrastructure assets which generate steadily income. And the sponsor is a person who set up. Sponsor is a person who set up the invite, and he appoints these trustees, investment manager, project manager, all those persons he will appoint to take care of the investment trust. Okay, investment manager, project manager. Okay, and another concept is your securitized debt instruments. Securitized debt instruments is where it is an instrument that is created by securitizing law. So if here the most common is your mortgage backed securities. Mortgage backed securities. These securitization company, what will they do now? These banks, as I stated earlier in the part of chapter, these banks will provide. These banks will have a mortgage property. They have mortgage property. They will sell it to the securitization company, and secure at a discounted price. Securitization company will take care of all the prepayment, all the interest collections, all those parts, which can be used to reduce the any irregularities in the sheet of the banks. It can clear. It can clear any bad debts on the balance sheet of the banks. It can clear. So securitization company helps to clear the uh, bad debts and can lower interest rates. Okay, so securitization company have a very powerful team to recover the amount from the uh, defaulter. Okay, municipal bonds is also referred as money bonds. It is issued by the government. It is also same paper bonds, but it should follow certain criteria. That's it. So it should not have any negative net worth in the previous years. No default. Directors must not defaulted. That's it. No record of default you should not have. And the government issues these, and the SEBI also issued us guidelines in 2015 about the municipal bonds. So with this, I had completed the entire chapter of the basics of capital market. That is your lesson 1. Uh, Thank you.